Hi, and welcome back to Sisterhood in Surgery, the October session. Today we are going to be talking about to be a bull or a bear, managing the stock market in the current economy. And of course, I have my co-host here, Palma, with me. This is a live webcast, and so you can send in your questions by web. Go to pollev.com, enter DeBakey, and we'll respond to that question, or join by text DeBakey to 37607 and send us in your questions. We have two special guests today, and I'll start with the introductions. Ilan Mui is my best friend, also a very distinguished journalist. She's currently a managing director at Penta Group, a global strategic advisory and public affairs firm. She works with some of the nation's largest companies and most influential nonprofits on reputation management, messaging, and media engagement. Before Penta, she spent more than 2 decades as a journalist, most recently at CNBC, covering Capitol Hill, and prior to that, the Washington Post. Her expertise is in economic policy, fiscal, and monetary. Welcome.
Thanks for having me, Linda and Palma.
It's our pleasure. And it's an honor and a pleasure to introduce Tom Santucci, who I've gotten to know as the treasurer of the Eastern Vascular Society. And he's taught me quite a lot, and I thought he has a lot to offer all of us on the show and all our viewers. Tom's experience as an investment professional spans more than 20 years, first as a financial advisor with Smith Barney, and then as a vice president of investments with UBS Financial Services. In those positions, he managed client assets concentrated in the areas of wealth management and retirement planning. He also established an investment advisory business, managing assets for individual investors and institutional accounts. As a member of the New York State Bar, Tom received his Juris Doctorate degree from the Touro College Jacob D. Fuchsberg Law Center. While actively practicing law, he was the managing partner of Santucci, Deckenberg, and Wasserstein from 1987 to 1995, and an associate in the firm of Shaw, Goldman, Lissitra, Levine, and Weinberg from 1983 to 1987. From 1986 to 1996, he served as a legislative counsel to the New York State Assembly, reviewing and assisting in drafting legislation and serving as a constituent liaison. Tom is designated as a certified investment management analyst and accredited investment fiduciary. The CIMA designation represents successful completion of a rigorous academic program conducted in conjunction with the Wharton School of Business, as well as high level of credibility, integrity, and knowledge. As a resident of Garden City, New York, Tom received a Bachelor of Art degree from St. John's University. He is the past chairman and current director of the Queens Chamber of Commerce, as well as director of the Boys and Girls Club of Metro Queens, where he previously served as president. He was elected and served as a member of the 10th District Committee for the Financial Industry Regulatory Authority, and recently was elected as a member of the Board of Directors to the Financial Services Institute and Medicist and Health Network. Welcome, Tom, and thank you for fitting us into that busy schedule of yours.
Palma, thank you very much. I was wondering who you were talking about at first, but I do appreciate it. Thank you. Thank you, Linda. Thank you, Ilan.
So we're here today. We thought about this topic. We've done financial topics in the past, and they've been really popular, and especially with the current outlook of the economy, the 8%, rise, current cost of living, inflation rate, and us being busy, we just wanted a little bit more advice on the basics of the current economy and how does that impact our decision in stock market strategy. And so we have these two experts, and we may even talk about some Taylor Swift economics, which I'm really excited about. So let's get started. So what is the current outlook for the economy? There's been a lot of talk about a recession, and so what do we expect in the near future? Ilan, do you want to start?
Sure. Here's the thing about the economy, which is that it's actually doing pretty good if you look at the numbers right now. The job growth in the country is really strong. In the latest month, we saw job growth by 336,000 jobs. That's more than investors had expected, and that's certainly much higher than the level that we saw, for much of the decade previous to this one. So job market is still looking really hot. GDP growth is coming in at about 2%. So the economy is at a really steady rate of growth. The unemployment rate is still pretty low at 3.8%. And so when you look at those numbers, you think, wow, things are going pretty good. But there's two issues here that are sort of hiding underneath some of those macro numbers. And one of them is the problem of inflation. Lots of people are seeing that the cost of gas at the pump or the cost of housing has risen quite a bit, and that is eating into essentially their purchasing power. People are finding that their dollar doesn't go as far as it used to. So even though people have jobs, even though the economy is still growing, what they're seeing at the grocery store, when they go to put gas in their car, is making them feel like the economy is maybe not working for them the way they would like. The second problem that we find with the economy is that sentiment is really low. So because of inflation, because of a lot of other issues that we see around the world, drama in DC, we see the terrible effects of the Ukraine war, we see what's happening in Israel, and people are feeling like, there are lots of headwinds facing the economy and they're feeling pretty down. So even though when you look at the numbers, you think that the economy is doing great, people aren't feeling it, and they aren't really confident about the outlook for the economy as a result.
I personally attest to that because I feel you wouldn't think that the economy was doing well with just how much everything costs, and especially in the medical field. Palm, I don't know about you, but I feel like the budgets are getting tighter. Industries not able to provide as much. I mean, don't you think that everything just seems less, there's less money in the bank when you look at in the medical field currently?
I would agree. Clearly, industry's on guard. They're watching every purchase and every donation for educational programming. So at least we feel that it's tight. We don't feel optimistic about the economy. Mm-hmm. I wonder, Tom, what do you think from where you sit?
Well, I think what happens, if you notice, there's a bit of a dichotomy about how we feel personally and what's actually going on in the economy. So even though we have these world events, as Elon pointed out, and have given people some trepidation, and even in business, Palmer, you mentioned the hospital and the funding, and there's a concern about that. The economy overall has been doing fairly well. Matter of fact, it's doing better than fairly well. It's doing very well. So you sit back and say, well, if I feel this way, why is the economy doing so well? And all you do is you take a look back or a step back, and you look at what the government has done to get the economy as strong as it is. And a lot of that has to do with some of the fiscal measures that they've put into place. Going back to 2019, something called the M2 money supply. For those of you who don't know what M2 is, M2 money supply is the amount of people have in the bank. It's cash, it's money markets, it's CDs. It does not include retirement plans. So back in October 2019, the M2 money supply for the United States was about $15.1 trillion. That peaked out in July of 2022 at $21.7 trillion. Currently, it stands at $20.9 trillion. Now, that's a lot of money sitting around to fuel this economy. And like I said, that's cash on hand. So until that excess cash gets exhausted, that's when the economy gets back into balance. So everyone feels that trepidation, but go out to a restaurant, hard to get a reservation. People are still out there spending. So we are awash in money. And you have to realize we had the PPP money that went out. There's been a lot of government stimulus. Student loans were put on pause for 2 years, just resurrected again. That gave the inflated effect of having more money. So a lot of these things, as they work themselves out through the system, will start to get the economy back in balance. So I think that's why you see, I call it a dichotomy as to what we feel and what's actually going on. Any thoughts?
Well, maybe this is yeah, no, as you say, this is really fascinating because I feel like there's a sort of self-fulfilling prophecy that could happen here, right? Folks are feeling a little bit worse because what they're seeing is that the stimulus and the money and the support from the government, from the Federal Reserve, from other corners of policymakers, that's winding down, right? And so now they're having to spend through some of that and maybe even charge now things on their credit card that they didn't have before. But the more that people feel bad and the more that people talk about the possibility of a recession, the more likely it is that a recession will happen because that sentiment can then weigh on their behavior. And economists, investors, everyone's been waiting for that self-fulfilling prophecy to happen. So far, it has not taken hold just yet. But again, that's why economists are worried about the fact that Americans still feel pretty gloomy. There was a phrase that I won't take credit for it because it was created by somebody else, but they called it a vibe session, right? This idea that we just kind of feel like we're in a recession, even if we aren't really in a recession. Again, we have inflation, we have the ending of fiscal and monetary stimulus happening. And so if people feel the vibes of a recession, could we actually then end up in an economic recession, especially at a time when there are these headwinds facing the economy?
So does the government impact, or can they, for example, through the Federal Reserve, can they influence the economy and therefore influence our emotion? I mean, I never realized there was so much emotion in this whole thing. Here I thought it was a science, but I guess more of an art, or maybe we can be manipulated. I don't know.
We can definitely be manipulated. So what happens, the Federal Reserve has raised rates going back to a year and a half ago. They brought the Fed funds rate between 5.25% and 5.5%. And they've done that. They initially started raising by 50 basis points, then 75 basis points at every meeting. Now they're really at the end of their tightening cycle. And the reason they raise those rates is they want to cool down this economy. With all that money floating around, they're trying to cool it down, because they're trying to get inflation under control. Now, unemployment is still very low. Usually when you get inflation under control, employment would start to rise. That has not happened. Inflation has slowed down, but it's still not at the Fed's targeted rate of 2%. Right now, we're running about 3.7% rate year over year. That's down from July 22 when it was 9.1%. So it has decreased the rate of increase. However, it's still running hotter than they would like to see. So the Federal Reserve at their last meeting held pat. They did not change interest rates. They have another meeting coming up in November, and then they'll have the December meeting, the end of the year. Right now, based on futures contracts, they're pricing in a 30% chance of a 25 basis point hike in December. That's pretty low. Now, when they raise rates, it takes a while to work through the economy to help get inflation under control. But it's going to be a wait and see attitude. So does the Federal Reserve have a lot of say or a lot of impact on what we say and do? Absolutely. The one thing about the stock market, and I repeat this all the time, is that earnings drive stock prices. So the better earnings, the higher the stock prices. When you have higher interest rates, it's more expensive to borrow money. And for corporations, that affects their bottom line and impacts their earnings. So if you have longer rates or higher rates for longer, that has the potential to affect stock prices and corporate earnings. So it definitely does have an effect. If you look at earlier this year, everyone thought that the Fed was going to start cutting rates probably the first or second quarter of 2024. Now they pushed that back and they said, maybe we'll get a rate cut the end of 2024. Fact of the matter is, no one knows. Another thing, you talk about recession and what's going on. You know, Paul Samuelson was a Nobel Prize winner in economic sciences. And he has a quote that I use. And his quote is, economists have predicted 9 of the last 5 recessions. So just think about that. Okay. Nobody knows. Nobody knows. And it's good to hear them talk about it. But, you know, the economy, it's a moving target at this point.
That is hilarious.
Yolande, I see you smiling, so.
Yeah, I think that's exactly right, Thomas. I feel like, you know, 2 things. One is the Fed maybe underestimated the resilience of the economy, along with, you know, many investors. Consumers have proven that they're still willing to spend, even though some of their resources may be dwindling. They're still willing to go out to the bars, go out to the restaurants, go out to the Taylor Swift and Beyonce concerts and pay top dollar to be there. So that's one thing. But there's also a question of whether, you know, the Fed's models really apply to the economy that we have today. Because the Fed, as Thomas pointed out, has raised rates at the fastest pace in history. And that has made all sorts of other interest rates go up as well. The amount it costs for the U.S. government to borrow, the amount it costs for individuals to try to buy a new home. All of those rates have gone up, and yet we have not seen that corresponding increase in unemployment. So does this mean that the Fed is not as powerful as it once was? Does this mean that the Fed's ability to rein in inflation is not as direct as it used to be? I think that the environment that we're seeing right now is really testing some of the theories that economists have held for a long time, because, as we've been saying, this is not a physical science. It's not a hard science. Economics is really more of a behavioral science that measures the way that we interact with each other and the way that we trade goods with each other. And that's something that human behavior is unpredictable. And so the economy is going to be unpredictable as well.
So do you think that the government, I think that maybe people are less trusting of the government or more in doubt, and maybe therefore the government may have less influence?
Now, Palmer, why would you say something like that? Why would they not be trusting in the government?
Yeah, I'm based out of Washington, D.C., so, you know, and I'm a former journalist, so there's a lot of skepticism of the government just in general. But you know, I think another reason why so many people had predicted that the economy would not be doing as well as it is by the numbers is because not just the Fed is raising rates, but that fiscal stimulus that we saw during the pandemic years is waning off, and the possibility of additional fiscal stimulus is essentially off the table. In fact, if we see anything, it's likely to be government spending cuts because of the negotiations that occurred earlier this year to cut spending around the debt ceiling, and because of the sheer dysfunction and the fact that Republicans and Democrats can't get along to do anything. There's not going to be any sort of additional fiscal package coming out of Washington in the foreseeable future. So that means, you know, more money for consumers is off the table. And it also means that if we do end up in a time period where we're in a recession, you know, it's unlikely that Congress is going to come to the rescue again.
Well, we're feeling this. We marched last summer to the Society for Vascular Surgery and the Executive Council. We went to D.C., went to Washington, Capitol Hill, because we wanted to pose some cuts. There's cuts, and we wanted things like, student loan forgiveness and things like that, because I think that a lot of the physicians, we need more people to go into surgery and to go into more specialty fields and go into medicine, and they're deterred by the high interest rates and things like that. And we're a little discouraged that the government isn't supporting, and they're cutting things for medical care.
Absolutely, yeah.
You know, it's a strange thing. When you see the government spending, I sit on an organizational board, and we had never received federal funding before. So what we did, we went out, we hired a lobbyist a year ago. We went from receiving 0 federal funding to getting $4.5 million this year. Now, I'm glad for the organization, but at the same time, I think it's a little bit excess. And that's what you're finding taking place. On one hand, organizations that could use the funding are not getting it. On the other hand, they're giving away money. And that is problematic. The other thing is this: when you think about politics, right now, the Fed is trying to engineer what they call a soft landing, so that growth will slow down, but we won't go into a recession. And by the way, just for purposes of the audience, a recession is defined as two consecutive quarters of negative GDP growth. We have not experienced that other than the first 2 quarters of 2022. Mm-hmm. Okay, this quarter, third quarter of 2023, is expected to be positive, as is the fourth quarter. So to go through a recession, 2 consecutive quarters of negative GDP. Next year, and not that I'm skeptical at all, Palmer, but next year is a presidential year. Okay, that means the party in power will probably do whatever they can to avoid any type of recession. And at the same time, they really do not want interest rates to get too high to push us into a recession. So you have a couple of competing influences at work here to try to keep this economy on track. So it really is a tightrope that they're walking. It's concerning.
Well, let me just point out that the Federal Reserve is an independent institution. It's essentially apolitical, but you're right that it is shaped by the environment in which it exists, right? If we were barreling toward a government shutdown or barreling toward a debt default, it seems unlikely that the Fed would choose that moment to raise interest rates, right? There's other macro factors at play here. But in terms of how the economy could impact the 2024 election, I will say that I was one of those people in 2022, and I was still a reporter who was saying that inflation and the economy were top of mind for voters, and it certainly would poll as one of the most important issues that voters were considering as they went to the ballot box. But when it came time to actually vote, it turned out that the economy may not have been as big of a factor as many of the pundits, and myself included, thought that it would be when it came to the election. So there are lots of things that voters are weighing. One thing that we do know, though, is that President Biden's poll numbers have not benefited from the economy in the way that definitely not in the way the administration would like, and maybe not in the way that many people would expect. And so, what we're anticipating is that if the economy stays relatively healthy, then that's essentially a neutralizing factor for President Biden's reelection chances. If the economy tanks or things get worse or inflation starts to spike again, then we consider that a headwind for President Biden's reelection chances. So right. At best, it can be zero effect on his incumbency, and at worst, it can be a headwind, but it's very unlikely to be a tailwind for him.
Well, so speaking of the GDP, because I mentioned it, so the Taylor Swift phenomenon, what is, I don't even understand. I mean, I guess that concept, she brings billions of dollars into the city that she picks for her concerts. And so, Tom, you were saying it affects the GDP. I mean, so the stock market's looking at this like,
so what happens, they came out with a report, and they said between Taylor Swift and Beyonce, it actually creates so much economic activity that it actually contributes to GDP. So for those who aren't Swifties, you ought to think about it. The other thing is this, when you look at GDP, assuming GDP goes down, okay, right now it's forecast about 2.1% for this year. Next year they're saying about 1.5%. If GDP goes down, that does not necessarily mean that the stock market goes down. Mm-hmm. Okay, because if you look at the past, we've been through years where GDP is down, stock market goes up. However, look at the reverse of that. If the stock market goes down, GDP tends to follow. And that goes back to Elon's point earlier. It's a lot of psychological effect here. If stock prices are going down, people are going to feel as though their wealth is going down, and they're going to pull back on their spending. So it's interesting how those two components kind of support or contradict one another. You would think the opposite of what I'm saying, but it doesn't work that way. So the effect of Beyonce and Taylor Swift absolutely is a positive, and we take it. But I don't think they're going to be on tour forever. And next year will be an interesting year to watch.
Yeah, we might have a natural experiment going on here because, not that I follow this super closely or anything, but Taylor Swift is coming back to the U.S. next year, almost exactly a year from now, for a 3-city tour before she ends her Eras tour altogether. So it could be kind of interesting for some enterprising economists to look at what ticket prices and the economic effect of Taylor Swift this year and what it looks like next year. And is there a differential? Is the consumer tapped out in October 2024? Or are they still willing to come out, fill those hotels, pay the top dollar for her tickets? One thing that I thought was super interesting is that the Federal Reserve puts out a bunch of really wonky, honestly very boring if you're not into monetary policy, documents about the state of the economy, et cetera. They have one document. It's called the Beige Book. And it's about as interesting as the name suggests. It's called the Beige Book for a reason because it's not that exciting. But one publication of the Beige Book did include a reference to the fact that Taylor Swift was drawing people out to hotels, restaurants, bars, et cetera, in Philadelphia. And it was actually a notable uptick in the economy. So there is a real connection between the Fed, Taylor Swift, the economy, and we can't forget about Beyonce's concert as well as contributing to GDP.
Yeah, and Elon has been to the Beyonce concert and is going to the Taylor Swift concert. So, she okay.
Don't tell my daughter.
Oh, okay, sorry. Yeah, I forgot. So, speaking of moving on to the stock market topic. So why are CDs and bond why is that rate of return so high currently? Is that?
Well, you have to realize with the Fed increasing rates the way they have, going from almost a zero interest rate policy to 5.25% to 5.5%, that brings rates up across the board. So a 1-year treasury as of today is paying about 5.4%, 1-year treasury. You go back a year and a half ago, and that was paying less than 1%. That's the direct result of the Fed raising rates. So when people or investors look at that and they said, my God, I could get a 5.4% rate of return virtually risk-free. Why should I take any risk in the stock market? Let me move some of my assets into treasuries. That's a risk that people are going to take money out of the stock market. However, again, everything balances out. If you look at the stock market this year, and no one would have forecast this, but the NASDAQ market is up nearly 30% year to date. The S&P year to date is up close to 13%. The Dow has been the laggard in the group. Dow is up about 2.5%. Well, when you look at those rates of return, the stock market will still give you the greatest potential reward. And all of that depends how you're investing, what your time frame is, and what your risk tolerance is. But it's been a good time for the stock market, regardless of what that risk-free rate of return is.
So you have not seen your clients or the trend that more people are taking their money out of the stock market? I mean, it seems they're evening it out to both.
I think the trend I've seen is that people who used to invest in fixed income funds, mutual funds, have taken money out of fixed income funds and actually gone out to buy individual treasuries. Now, when we talk about the stock market and the stock market this year being so great in terms of returns, last year was the opposite story. Last year, the NASDAQ market was down approximately 34%. The S&P was down 19.5%. The strange thing is that the bond market was down 16%. Now, generally people jump to bonds to protect them from stocks. But even the bond market being down 16%, it was not a safe haven. This year, I gave you the numbers for the S&P and the NASDAQ. The bond index this year is actually down 1.7% year to date. So it still hasn't recovered. And the question is why? So when you look at bond funds, visualize a seesaw. And Palma, we do this all the time. What happens as rates go up, the value of bonds goes down. And we've seen rates go up, and that's why bond funds have gotten hit. So the money I've seen shifting lately is leaving funds and going to individual treasuries. And the reason I say treasuries, because you tie up your money for that year, 6 months, a year, 2 years, 5 years. But the fact of the matter is, your return is guaranteed, and at maturity, you get your money back. That's much more enticing than going into a fund where you're more susceptible to the interest rate effect. That's in terms of stocks, I've still found people to be involved and engaged in the markets.
We have a question from the audience. Where does cryptocurrency fit into all this?
Elon, you're smiling. Do you want to take that, or?
Well, maybe we're going to have to see what the result of Sam Bankman-Fried's trial is before we answer that question. I mean, I feel like crypto was the buzzword for much of last year. People saw crypto as a way to perhaps reach for yield at a time when we weren't getting that type of yield out of treasuries, out of bonds, et cetera. And so folks were maybe investing in assets that they thought would give them an unusually high return. And for a while, maybe it did. But I think where we are in the crypto space is that there's been a lot of shedding, maybe separating the wheat from the chaff here. And we've seen a lot of concern, a lot of inquiries, legal, congressional, regulatory, into certain types of assets. There's a lot of current questions around what exactly should be regulated and how. So I think the industry itself has maybe retracted and retrenched a little bit, but that the players who are still standing are more likely to be around for the long term than the FTXs of the world.
So Elon is much nicer than I am, because I think at this stage it's a fraud. I tell my clients, if you could explain it to me, you could buy it. And everyone's silent. You have an unregulated market. You have competing interests. You have things that are converted to dollars at the end of the day in terms of trying to evaluate them. The whole thing is a bit too remote. And I'd be very, very hesitant to invest at all in that market. So Elon, like I said, you're much, you gave a nicer review, but I would stay far away. I think it has a lot of maturing to do before it could even be considered.
I have a question.
Go ahead, Palma.
I have a question. So as an investor, first of all, I used to live in Manhattan, and I would hear everybody say, bull market or bear market. So I didn't quite know if we could go over that a little bit. And then a lot of this investment relates to your age and how aggressive you want to be. And do you want to be aggressive or conservative? So when I manage this stuff, the portfolio for the Eastern Vascular, we're conservative. They've chosen to, and you've done a beautiful job with that, with the T-bills and the short-term rates, and we've remained very in good position with that. But if you could explain, maybe between you and Elon, as an investor, how do I look at the market and feel comfortable? I mean, how do I get into this?
What we try to do when we formulate portfolios or look at the market, Number one, you look at your time horizon. A normal market cycle is 7 years from peak to trough. So if you have less than 7 years, you can't withstand the market cycle. So you have to be much more conservative. That's one aspect. The other thing is your risk tolerance. Certain people, if their account goes down, they can't sleep at night. Okay? If you can't sleep at night, you got to do what's best for you. No matter how much possible reward there is, you have to feel comfortable in your investing. Years ago, they used to have a rule of thumb. They would say, take the number 100 and subtract your age, and that would tell you what your equity position should be. So if you're 100, you take away, let's say, 60 years of age, you should have 40% equities. And that used to be the old rule until these doctors started to create longevity in our lives. Now what happens is that they said use the number 120 to start off with. 120 minus 60 means at 60, you have 60% of your portfolio in equities. So your time horizon has to change because your life expectancy is increasing. So that's an effect. The other thing is the first thing you do when you create a portfolio is you look at what your cash needs are. How much income do I need to live on? And then after I meet that need, then the rest of the money should be exposed for growth for a longer term. Because it's the only way you're going to stay up with inflation, and it's the only way you're going to grow a portfolio is by having exposure to equities. So you have to conduct that analysis, generally with an advisor, and this way you go and you formulate a proper portfolio. In today's times, there are all different types of investments to meet those needs. And Palmer, as you know, ETFs, which are exchange-traded funds, an ETF is a basket of stocks. Well, they have those products designed where they have what they call built-in buffers, so that you could buy an ETF on the S&P 500, the overall market. You cap your upside return annually to 15 to 18% on the upside. However, they give you a 15% downside protection, which means that if the market would drop 15%, you don't lose a dime. If it drops 20%, you would lose 5%. So it's a way to get equity exposure without taking as much equity risk. But you have the opportunity to get above average returns. So it's products like that. It's different investments that are available. And that's the way you overcome some of those restraints in terms of time horizon and risk tolerance.
Thomas, am I allowed to ask you a question? Because
sure you can.
I have one for you. I thought
it depends what the question is before I say no.
I thought that your comment about time horizon was super interesting. And I'm wondering if you're seeing your clients still target 65 as the age of retirement, or if, because maybe, hopefully, thanks to Linda and Palma, we're not just living longer, but we're living longer with a healthy, mobile lifestyle to accompany it. So are you finding that folks are able to work longer or want to work longer, and then that also changes the amount of time that they need to plan for in retirement?
It's funny you say that. I have a couple of my friends, they're all close to my age, and 3 of whom just retired, and they're in their early 60s. My father had retired when he was 60, and it was said the biggest mistake he ever made. He was too young, and he admits that. My uncle, his brother, he told him, don't retire. My uncle retired at 84. So retirement is perhaps a personal preference. I have not seen a rush out the door at 65. I find that most people today are working closer to 70, 72. I'm finding that to be the age where people are seriously thinking of retiring. And another trend is they're not looking to retire full time. Mm-hmm. They would like to do something. They don't want to work full time, but they want to do something. So if they could keep on as a consultant or work part-time, that would be their preference. But I think the age where most people, or I have found, look to actually put in those retirement papers is closer to 72 today instead of 65. Different.
So how would you retire early? I mean, the opposite question.
That's a whole trend as well, at least according to the kids on TikTok. They call it FIRE, financial independence, retire early, and they're all about saving aggressively to, go into retirement by the age of 40 or 50 even. But I think that there's, to your point, Thomas, there's also a lot of questions around, well, what are you going to do with your time after that? Even if you have the financial means to step back from the workforce, are you going to be happy and fulfilled, or what's the goal?
It's not only that, but the idea is if you retire, I always tell everyone, I do a lot of retirement planning. And I said, you have to plan for it. It's important. But at the same time, you have to live. Okay, you can't throw everything into retirement savings and not enjoy life. The biggest discussion I have with clients is they'll say to me when they're in their 60s or 70, geez, I don't know if I should take that trip. Maybe I'd have to save more money. And I said, do it. Go away. Take the trip. Because when you're 80, you might not be able to
take the trip.
The steps.
Yeah.
That's right. So you got to enjoy it while you can. You got to be prudent when you do it, but don't let life get away from you trying to save everything for the future. I really firmly believe that.
Absolutely.
I've had too many patients come in my office who said they were going to travel when they retired, and then they come in and they have a thoracic dissection or they have some major catastrophe, and then they never do it, or they can't walk. They're claudicators, so they can only walk 2 blocks. Imagine the airport now. I've been traveling recently. It's miles to get from the one gate to the other.
How many times do you walk through an airport and someone with a wheelchair almost knocks you over? That's the other thing. They all get on wheelchairs.
Yeah.
And then when they get to the plane, they get up off the wheelchair and they walk in. So it's a phenomenon.
So, Palma, did you want to talk about the 529? I mean, just in terms of physician-specific questions.
Yeah, I mean, I guess I'd like to hear, let's say you're just coming to, you're 5 years out, or let's say you're 20 years out in practice. How would you work the 529s?
So the 529 plan allows you to put money away, for a child, a grandchild, to be used for educational expenses. That's room, board, it's books. So it has broad use, anything to do educational-wise. The amount of money that you could put into the 529, you can gift $17,000 a year without incurring any type of gift tax. And you could front load a 529 for 5 years. So conceivably, you could put $80,000 in a lump sum. So it's a great advantage because if that money is used for educational expenses, it grows tax-free. That's a big deal. Every state has a different rule regarding a 529. However, some states, allow you as the donor into the 529 to take a state tax deduction for the money you put in there. So that's another great incentive. So I think it's a great vehicle to save for the future generation. Not only do you get the tax deduction, possibly, depending on what state you're from, but more importantly, it grows tax-free for tuition. And regardless what we say about inflation, the economy, I really don't see tuitions going down. So I would say start early and start saving for those. I think it's a great vehicle to save. Let's say a child doesn't go on to secondary school, doesn't go on to further education. Well, then you can take that money out. You get hit with a 10% penalty on the growth if it's not used for that purpose, but that's a small price to pay. The other thing is Congress recently just proposed a bill so that, and there are certain limitations to it, that part of that money can be taken out and converted to a Roth IRA. So it's interesting what they're doing with 529s, but it's definitely worth exploring. Absolutely.
And that's state dependent, the Roth
Yes.
conversion? So if I have two
The Roth
529
provision will be a federal provision.
Oh, federal. So I have two 529s, two children. If I don't use all of it for one, they said I can roll it to the other child.
You can. You can roll it to another child. You can roll it to, a relative, anyone.
Really?
Oh. Okay. Oh, okay. Relative. All right.
Yep.
That's
Okay.
I just had a question.
And Plum, I have 3 children. My kids are done with school. Too late.
So I always found options to be a little bit of an enigma, and I was reading a little bit about it, and it was that they're a little bit protective. I mean, is it a good thing to get into the options market, or?
So, when I first got in this business, I loved options, and I tell everyone the story that I bought my first house through options, and it's true. Everything I wanted to buy, I just couldn't afford, and I took some option, risk, and I was able to afford the first house. Now, the other part of the story is that I probably lost 3 other houses after that. So, options are a great strategy that people should be aware of. So when it comes to options, there are basically 2 kinds: a call option and a put option. So if you buy a call option, you buy the right to call a stock, to buy a stock at a predetermined date in the future at a predetermined price. So for example, let's say Apple. Apple's $175 a share. If I bought an option, a call option to buy Apple between now and January at $175 a share, that's what's selling at today, I would probably have to pay a premium of $8 per share today for that option. So what that does for me, instead of going out where, let's say I wanted to buy 1,000 shares and laying out $175,000, what I would do is I would lay out $8,000 and control 1,000 shares worth of stock. If Apple goes up, as long as it goes up 175 plus the 8 that I paid, so it'd have to go to 183 or higher, I make money. If it goes down, I lose $8,000. So it's a way to get leverage to invest in stocks. Conversely, that's buying a call option.
But you can buy any time during that period, though, so you would watch.
You could buy it. You could do it anytime during that period. You don't have to wait till January.
Okay, so
Right.
you would just watch it daily and say, okay, today it's 185, so I'm going to buy
Right.
it today. I'm going to cut my chances, get $2 per share on top of what I paid.
Yes.
Okay.
So when you price options, they look at time and the strike price. So let's say Apple 175, let's say it goes to 180. I told you have to get to 183 before you really make money because you paid $8. But if it went to 180 next week and that option expires in January, that $8 you paid is probably worth $11 today because it went up in price because you still have a couple of months until expiration. So the distance between when you buy it and the expiration, that determines the premium as well as the actual price of the stock. So that's called purchasing a call. The most conservative strategy is selling a call option. So what that involves, that means that you have to own the stock. So let's say you own Apple at 175. And you say, I bought Apple at 175. I'm worried about the market. I could sell someone the right to buy that stock from me. So it's bought at 175. I could sell them a 200 call. They have the right to buy it from me at 200 between now and January. And perhaps they pay me $3 per share. I have 1,000 shares. I take in $3,000. If Apple closes below 200, I keep the stock and I kept that $3,000. If it closes above 200, I'm out at 200, but I got $3 for the call option. So I got 203 as my effective price. So it's a way to hedge a portfolio. If the market were to go down and Apple goes from 175 to 165, it's down $10, you only lost $7, or you're down $7 because you took in that $3 premium. So when you sell a call option, it is the safest option strategy you could employ. So that's on the call side. Just to confuse you further, you have something called put options. So when you buy a put option, you're buying the right to put the stock to someone. So I own Apple at 175. What I do is I buy a January 175 put. That means I can make somebody buy that stock at 175 between now and January. Apple drops to 150. That option, I make you buy it at 175. It's only 150. So that's a way to insure a portfolio that you can't lose the money because you now have insurance at 175. That's called buying a put option. Conversely, you can sell a put option. And then I finish after this, Elon. Selling a put option means that without owning any stock, I give someone a right. I sell the right that they could put the stock to me. So I think Apple is a great stock. I'm going to sell a put. I own nothing. I sell a put. Okay. Someone pays me that, $8 to buy Apple at 175 in January. They could force me to buy it. I'm betting that Apple is going to stay where it is or go higher. If it stays where it is or goes higher, I took in that $8 premium. That means on 1,000 shares, I take in $8,000. If Apple drops to 150, I have to buy it at 175, but I took in $8, so my effective cost is 167. Right? So that's calls and puts. They have a place, I believe, in everyone's portfolio, depending on the level of risk you want to take. But I do employ them quite often, and I think it's a great strategy to be aware of. Highly recommend.
That was hard to find. That's so I mean, this is why I don't do finances, because I'm like, wait, okay.
Now, it's funny, Linda, because every time I do that for a client and I explain the calls and the puts, they generally say, Tom, just do it. I don't understand what the heck you're talking about.
Yeah. It sounds like you know what you're talking about.
And then they learn it as we go along. Okay.
That'll be me. That's me.
Yeah.
I think Alon wanted to bring up a point about a woman that won the Nobel Prize in economics. Do you want to comment on that, Alon? Because we'll be finishing within 5 minutes.
Sure. First thing I want to say, Thomas, that was a very clear articulation of calls and puts. I really appreciate it. As a reporter, we were never allowed to own individual stocks. You could only own a broad index fund, for example. So there's still, even though I worked in financial news outlets, there's still definitely a lot that I'm learning as well.
Good.
So thank you for that. But I did want to bring up what I thought was really notable and interesting news in the economics world, which is the awarding of the Nobel Prize in economics to Harvard professor Claudia Goldin. I became familiar with her work when I was an economics reporter at the Washington Post, but also when Janet Yellen, who was formerly who is now Treasury Secretary, who was formerly head of the Federal Reserve, as she was going through her nomination and confirmation process. Claudia Goldin was of an era of women who were sort of groundbreakers, the first of their class, one of the few women to get PhDs, one of the few women to become tenured professors at some of the most elite schools in the country. And Claudia did this by making her name in studying the role of women in the economy. And so I thought that was something that was really important to bring up during this conversation. She was the first woman to understand that women joined the workforce not just in order to earn an income and contribute to their households, but also to create a career for themselves. And this sort of phenomenon of this change in thinking amongst women in the 1960s, she called this the quiet revolution, as women began entering the workforce in greater numbers, again, in order to pursue their hopes, dreams, and their goals. She was able to document the role that birth control had on women's labor force participation. As women gained more control of their biological life, they were also able to take more control of their economic life as well. And then what really struck me was that she was one of the first people to really understand the root causes of the gender wage gap. We all know that women on average still don't get paid the same as men in this country. And increasingly what she found was that this was not because women were taking lower paying jobs or working in lower paying industries. There's not more women who were teachers and who were doctors, for example. The real issue she found was that even within the same sector, even within the medical field, for example, or even within the journalism field, women and men were not getting paid the same rate. And that was largely attributable to women deciding to become mothers and having children. So she was someone who identified that the wage gap was really a motherhood gap. And that's really important, not only in our understanding of the economy, but then also in our understanding of what policies on the federal, state, and local level can be put into place in order to make sure that women get paid what they're worth. So congratulations to Dr. Claudia Golden.
Congratulations.
Yeah.
It's amazing when you think about it, but, along with those findings, you think about the two women we spoke about earlier, Taylor Swift and Beyonce, how they directly affect the economy and the GDP.
Yeah.
Women have a lot of economic power, absolutely. Deservedly so.
Yes, definitely. And, I told Palma this the other day. I said, despite the amount of power she has, she still has that song, The Man, that she put out in 2019 of like, could I have gotten here faster if I were a man? So, even right. Taylor Swift feels that, gender disparity, I guess. But that's the reason why Palma and I have this show, is to just bring light to all the issues that women, not just, women vascular surgeons, but sort of all women feel and in their personal and career life. And I think that's why we enjoy what we do every month.
I think it's a great job, and you have a lucky audience for sure.
Thank you so much.
We really appreciate your time. Learned a lot as always, and I'll continue learning more from you, Tom, our quarterly discussions.
Thank you.
Thanks for having this discussion, guys.
Good night.
All right. Enjoy. Bye now.
Bye-bye. Thank you.